You know that tiny thump your heart does when a letter arrives from a tax office with your full name and an alarming bold line? That's the universal soundtrack of uh-oh. We're walking through the 10 biggest red flags that put your file on a reviewer's desk, and how to keep your returns so tidy they practically purr. Ready? Deep breath in. Paper cuts out. If you think spending fewer than 183 days anywhere makes you tax-free, you're building a house on jelly. Some countries use a day count for residency, some don't, and many treat it as just one ingredient in a stew that also includes where your real home is, where your family sleeps, where the money work happens, and whether you've actually settled or are just passing through. Treaties can overrule local rules with tiebreakers like permanent home and center of vital interests. And for business, the trigger might be a permanent establishment, basically a real footprint like an office or someone signing deals for you. What keeps you clean is simple grown-up homework. Map where you truly live, work, and manage your affairs, run the relevant test for each country you touch, and write a one-page memo in plain words for future you. Proof beats vibes. Travel logs, leases, school letters, board minutes, and payroll registrations beat screenshots of beaches. In the next chapter, we meet a red flag that doesn't care where you sleep, only what third parties reported about you. Tax systems run on data matchups. Platforms, banks, brokers, marketplaces, and sometimes even app stores send reports about your payouts. If those numbers don't show up on your return, alarms ring like a fire drill. Think marketplace fees, ad credits, interest, dividends, stock sales, staking, or airdrop income that a platform logged, or a payroll summary you forgot. Even when you believe an amount is non-taxable, the mismatch alone can trigger a curious letter. Your antidote is ruthless reconciliation. Before you file, collect every year-end statement, the CSVS, the payout dashboards, and the tax documents sections you usually ignore. Tick and tie them to your return line by line. If something truly isn't taxable, attach the law logic and keep the evidence. Even when the totals match, the shape of your numbers can still raise eyebrows. You claim sky-high expenses with a whisper of revenue. To an auditor, that can look like a hobby disguised as a business, personal spending in a business costume, or an enterprise that exists only for tax losses. Classic hotspots are travel and meals every other day, a luxury home office that suspiciously resembles your entire apartment, and round number expenses that look like they were invented in a taxi. To stay clean, make your books tell a grown-up story. Keep receipts, calendars, agendas, client emails, and a clean split between business and personal. If you run losses, show the commercial plan, market research, pricing, customer pipeline, and the realistic path to profit. If it's truly a hobby, treat it like one and enjoy it without trying to feed it to your tax return. Ready for a twist? The next red flag flips the telescope to money you never mentioned at all. Cash-heavy lines, hospitality, small retail, services paid in envelopes, attract scrutiny because cash disappears quietly. Crypto adds a sci-fi layer, staking rewards when you have control, airdrops you can transfer, and DeFi moves where a wrap, bridge, or restake can be a taxable event, even if your wallet balance feels unchanged. In some systems, if you can move it, you just earned it. In others, certain airdrops for private holders can be zero at receipt, but taxable on sale within a year. Same click, different country, totally different math. The adult move is to track like a librarian. Keep a wallet timeline of when you received, when you could first move, and what the fair market value was then. Note disposals, lot IDs, and holding periods. Save exchange exports and explore links. If a platform reported your digital asset activity, expect the tax office to compare it to your return. Our next bump in the road. A little line on invoices that people overlook, until it quietly pushes your costs around the map. You open your ad invoice and see a new line called Digital Services Tax, or your App Store proceeds dip only in certain countries. That's not your funnel breaking. That's a country skimming a small percentage from digital revenue tied to its local users. Platforms often pass that cost through to advertisers, sellers, or developers. You won't be audited for DST itself, but you can get flagged when your reported margins or VAT GST positions stop making sense next to those pass-through changes. Your job is to document the flows. If a platform adds a DST surcharge or changes regional proceeds, reflect that in your cost of sales and in your indirect tax treatment. Keep the billing notices and rate tables. If your after-tax ROAS or per-country margins swing, keep a short note that says why. When your paperwork says one thing and your life says another, auditors don't need DST to be interested. Auditors love contradictions. You could claim your company is managed in country X, but board decisions, signatures, and actual work happen in country Y. You insist you're non-resident, that you keep a furnished home, your family stays, and you run staff locally. Or you swear your foreign subsidiary is independent, while all pricing and contracts are actually steered from your main office. That's how you wander into permanent establishment risk, place of effective management trouble, or transfer pricing headaches. Clean living means aligning substance with the story. Hold real board meetings where you say management lives. Keep minutes, resolutions, and access logs. Sign contracts in the declared place. If staff or a dependent agent in another country habitually closes deals, acknowledge the footprint and structure of property. Some regimes run on clocks. Miss Spain's entry election for its expat regime within 6 months, and the door shuts. Forget to tick the digital assets question on a U.S. return, and you've invited follow-up. Skip foreign asset or foreign account reports when thresholds are met, and you've earned penalties you'll hate telling your future self about. VAT/GST registrations can be triggered before your accountant finishes her morning coffee. Your shield is a calendar with angry reminders. List every filing and election that could possibly apply and assign a responsible human to each. When you genuinely blow a deadline, use the official fix-it paths. Voluntary disclosures, amended returns, reasonable cause letters. Paperwork isn't exciting, but it's often cheaper than bravado. Humans love round numbers. Auditors love them even more. A year of exactly 10,000 for marketing, exactly 5,000 for travel, or exactly 20% home office whispers that the numbers came from the ceiling. Patterns matter too. Every meal exactly the same cost, mileage that never varies, or sudden end-of-year supplies that perfectly erase profit. Staying clean means you let your receipts write the story. Use actual miles, actual invoices, actual subscription fees, and bank statements. If you estimate, disclose that you used a reasonable method and keep the worksheets. Where rules allow safe harbors, like certain simplified home office or per diem methods, use them correctly and consistently. Tax law doesn't ban passion. It bans pretending your passion is a business when it never aims to make money. If your company shows losses year after year with no credible plan, no pricing discipline, and no customers beyond your ant, an auditor may reclassify the activity as a hobby or personal consumption. Then deductions collapse like a pancake without eggs. If you're serious, behave like it. Separate accounts. Track leads, proposals, conversions. Adjust pricing when costs rise. Keep a simple forecast that shows how the numbers work. If you're not serious, that's okay. Enjoy the hobby and take the pressure off your taxes. Ready for the final boss? It's the one that catches people who think taxes are just income and expenses. They forgot about payroll, social security, and classification. Reclassifying employees as independent contractors to dodge payroll burdens is like hiding a watermelon under a napkin. Everyone sees it. If you control the worker's schedule, tools, and methods, many systems treat them as employees. Get that wrong, and you can owe back payroll taxes, social contributions, penalties, and interest. Cross-border setups add spice. Even if you dodge income tax in a country, you may still owe Social Security there under coordination rules or totalization agreements. The clean path is to classify roles by the actual facts, not wishful thinking. Use written contracts that reflect reality. Register payroll where work is performed. Secure coverage certificates where agreements allow and remit contributions on time. For remote workers, ask 2 separate questions every time. Where is the income tax and where are social contributions due? You've now met the top 10 red flags. But how do you stitch all the defenses together so you sleep like a cat in a sunbeam? Start with your residence map. Write down, in plain language, where you truly live, where your family lives, where you actually work, and where your company is managed. For each country that could claim you, run the local residency test, and, if there's a treaty, run the tiebreaker ladder. Permanent home, center of vital interests, habitual abode, and then nationality. If you don't like the likely answer, change your facts before the year starts, not after the audit letter. Next, grow a reconciliation habit. Before you file, gather every platform report, bank and broker statement, payroll summary, marketplace payout, and crypto CSV. Check that your return mirrors the totals and that you've explained any oddities. If your life includes digital assets, capture the 2 things auditors care about most: when you had control and what the value was at that moment. If your life includes cross-border ads, marketplaces, or app stores, File away the system notices that explain DST or regional proceeds changes so your margins make sense on paper. Keep your deductions honest by building a paper trail that a reasonable stranger can follow. Meeting notes for travel, client names beside meals, vendor invoices for supplies, and real-world math for your home office. Where your numbers look weird, big loss, big refund, brand new category, write a 2-sentence explanation and keep it with your records. If you ever need to reply to a notice, those 2 sentences become the spine of your response. Respect the clocks. Elections, registrations, annual returns, foreign asset reports, payroll filings. Each has a calendar, and none of them care that your dog ate your Wi-Fi. If you mess up, fix it fast and politely. The penalty tables are kinder to people who show up early with paperwork than to people who arrive late with attitude. Align your company's body with its passport. Where are board decisions made? Who signs? Where do directors actually sit? If you're using a holding company, does it really hold and manage? Or is it a cardboard cutout? If a team or a dependent agent in another country is making and closing deals, deal with that reality openly. Register if you need to, and price intercompany transactions with documentation that passes the sniff test. Finally, treat your tax life like a documentary, not a mystery. 1 page per year that says where I lived, what changed, big transactions, and why, elections filed, platforms used, and anything new or weird. Staple the page digitally to your receipts and statements. 5 years from now, when an officer asks about that airdrop in the spring or that new office lease, you won't rely on your memory. You'll have receipts and a narrative. Audits aren't random thunderstorms. They're usually weather you can see forming. Mismatches, contradictions, missing forms, numbers that don't make human sense, and stories that your facts can't back up. The 10 red flags we walk through are the usual suspects, and your defenses are comfortingly boring. Clarity about where you live and work, accurate matching of what others reported, documentation for what you deducted, honest treatment of cash and crypto, and respect for the calendars that run the whole system. If you remember one thing, make it this. Tax agencies don't expect perfection, they expect coherence. When your story matches your paperwork, and your paperwork matches the numbers they already have, you glide. When you hide behind magic numbers, round guesses, or my friend said, you wobble. Keep it real, keep it documented, and keep it on time. Do that, and the next official letter with your name on it will be something pleasantly dull, like a refund you actually understand.